are you navigating this market?
Yeah.
It feels pretty unpredictable, right? You're holding onto your stocks, hoping they'll grow, but maybe wishing there was a way, to make them work for you right now. Generate some income consistently. Well, what if I told you there was a strategy? One that could actually pay you, maybe monthly, just for owning stocks you already like and believe in.
Yeah.
Even if those stocks just kind of sit there. Today, we're doing a deep dive into what some people call the ultimate covered call strategy. And this isn't just like defining a term. We want to give you a complete blueprint, really step by step, how to turn your portfolio, the stocks you have now, into this powerful income generating engine. We'll cover the basics, sure, but also get into some advanced stuff, techniques for different markets. We're going to cut through the complexity, hopefully, so you can actually put this to work.
Yeah, and what's really interesting, I think, is how it shifts your whole viewpoint. You go from just, passively hoping the price goes up to actively managing and generating cash flow, right? From assets you already own. It's really about optimizing, making your portfolio more efficient.
Okay, so let's start right there, the beginning.
Yeah.
When we talk about a covered call, what is it exactly? I've heard this analogy, like owning a rental house. You own it, right? And you agree, maybe, to sell it later at a set price. But for making that promise, you get paid like a deposit today, an upfront fee you keep, no matter what happens. Is that close? For the market.
That's a great analogy. That's precisely it, yeah. So, translating that. In the market, a covered call means you own the shares first, at least 100 shares of a stock. And then you sell someone else the right. And that's the key word, the right, not the obligation, to buy those shares from you. There's a fixed price involved, that's the strike price, and a deadline, the expiration date. And for selling that right, you get paid upfront. That's the premium, that cash. It lands in your account right away, instantly. Yours to keep. That's the core deal.
Okay. Mechanics make sense. Premium, strike, expiration. Got it. But, there are tons of strategies out there. Options are complex. Why were we calling the covered call like the ultimate strategy for you listening? What are those benefits that really make it stand out?
Well, I think it really tackles some common frustrations head on. First, and this is usually the big draw, it generates consistent income. Like your landlord analogy, collecting rent. You're turning stocks that might just be sitting there into a source of regular cash flow. And often this income stream can be, quite a bit higher than standard dividends, more consistent too sometimes. Second, every bit of premium you collect actually lowers your cost basis on the stock.
Right. So if you bought it $50.
Exactly. You buy it $50, you collect a $2 premium selling a call. Your effective price, your break even, is now $48. It just builds in a bigger cushion. And third, that premium. It gives you a bit of downside protection. Now, it's not, a magic shield if the market tanks hard, let's be clear. But if the stock stays flat or dips just a little, that premium you kept helps offset the loss. It can soften the blow. Might even keep you slightly profitable on paper when you otherwise wouldn't be.
That clicks, yeah. So it's really about making those assets sweat a bit more for you. It gives you some control, some income, things that buy and hold might miss, especially when the market's just chopping sideways. It's proactive.
I like that. All right, so we get the why. It sounds compelling. Now the fun part, the how. This can seem like the tricky bit, right? Options, chains, strikes. But you said we've boiled it down. A simple 4-step process. How do we actually do this?
Let's lay out that blueprint.
Yeah.
4 steps. Step 1, the golden rule. And this one, absolutely non-negotiable. Seriously.
Yeah.
So many people get this wrong. You must own at least 100 shares of the stock first. And critically, it has to be a stock you're genuinely happy holding for the long term. A quality company.
Right, not just some random volatile thing you hope pops. Exactly. We're not speculating on, penny stocks hoping to juice the premium. This is about generating income from solid businesses, companies you have conviction in. That's foundational. Okay, step 2. The setup, picking your strike and expiration. So you'll go into your trading platform, find the option chain for your stock. Looks like a big table of numbers usually. 2 big decisions here. First, the strike price. For income, generally, you want to pick a strike that's out of the money, OTM, meaning it's above where the stock is currently trading.
Why above?
Good question. Because that gives your stock room to potentially rise a bit without getting called away immediately. You still collect a nice premium, but you're not instantly capping your upside right at the current price. Now, how far above? A good rule of thumb, maybe for beginners, is looking at the delta.
Mm-hmm.
Find an option with a delta around, say, 0.30.
Okay, delta 0.30. What does that actually mean, though?
Yeah, delta gets technical fast, but think of it simply like this for now. A 0.30 delta suggests very roughly, a 30% chance the option will finish in the money, meaning the stock price will be above your strike at expiration. So, conversely, about a 70% chance it stays below. It helps you balance getting a decent premium versus the likelihood of keeping your shares, sets you up for that ideal income scenario. Second decision in step 2, the expiration date. Often, the sweet spot is somewhere between 21 and 45 days out, like 3 to 6 weeks.
Why that time frame specifically?
It's about time decay, or theta, another Greek letter, sorry. But basically, options lose value as time passes, and that decay speeds up significantly in the last month or so before expiration. As the seller, time decay is your friend. You want the option's value to erode. Selling in that 21-45 day window helps you capture that accelerated decay effectively, and selling monthly. That sets you up for those regular, recurring premium payments. Step 3. Execute the trade. Simple enough. You've picked your strike, picked your date. Now you place a sell to open order. One call contract for every 100 shares you own and want to cover. Order fills. Boom. That premium cash hits your account instantly.
Nice. Instant gratification, pretty much. Step 4, the 3 outcomes. Now you wait until the expiration date. One of 3 things is going to happen. Scenario A, this is often what you want for pure income. The stock price stays below your strike price. What happens? The option expires worthless. Nobody wants to buy your shares at a price higher than the market price. So you keep your 100 shares, you keep 100% of the premium, and you're free to sell another call for the next month. Repeat cycle. Okay. Ideal for income. What's B?
Scenario B. Still a win, usually. The stock price goes above your strike price. In this case, your shares will probably get called away, sold, but they're sold at that strike price you chose. So you made money on the stock's rise up to the strike price. Plus, you still keep the entire premium you collected initially. It's a profitable outcome.
Right, but that's where that feeling comes in, doesn't it? The FOMO. Fear of missing out. Like, what if the stock gets called away at $55, but then it zooms up to $65?
Yeah.
You made money, sure, but you missed that extra $10 jump. Feels like you left money on the table even though it was technically a win. How do you deal with that?
That's a huge point. It's psychology, right? Behavioral finance. And the professional mindset here is crucial. If your shares get called away, you set a target profit level when you chose that strike price, and you hit it. It was a successful trade based on the plan you made. You generated income. You potentially got some stock appreciation. Mission accomplished. But what if you really, really don't want to sell those shares? Maybe you think it has much further to run.
Yeah, exactly.
Okay, this brings us to maybe the most powerful tool in the covered call traders playbook, rolling the position.
Rolling. Okay, what's that?
Think of it like adjusting your agreement. Let's use your car analogy again. You agreed to sell your car next month for $10K, got a deposit. But now, cars are hot. Yours is worth $11K, and you want to keep it longer. So, you go back to the buyer, you basically buy back your promise, maybe give them a bit of their deposit back. That's called buying to close the current option. Then immediately, in the same transaction, usually you make a new promise. Sell a car for $12K, but maybe 3 months from now, and you get a new, maybe even bigger deposit for that promise. That's selling to open the new option.
Ah, I see. So you buy back the old option, sell a new one further out.
Exactly. You buy back the call you sold, which might cost a little bit now that the stock has gone up, but then you immediately sell a new call option, usually one with a higher strike price, giving your stock more room to run,
Right.
and a later expiration date, giving you more time. And here's the kicker. Often, you can do this whole roll for a net credit.
Meaning you get paid more money to do it.
Precisely. You receive more cash for selling the new, further out option than you paid to buy back the old one. So you've potentially pushed your profit target higher, given yourself more time, and collected even more premium income in the process. Rolling is how you can continue generating income from a winning stock, manage that FOMO risk, and potentially avoid selling shares you want to keep. It's incredibly flexible. Okay, and then the last outcome, scenario C. The stock price falls. Not great for your stock value, obviously, but you still keep 100% of that premium you collected up front. It acts as that buffer we talked about. Stock drops $3, but you got $2 in premium. Your net paper loss is only $1 per share, not $3. That's the downside protection kicking in. It cushions the fall.
Okay, so rolling helps with the FOMO risk. What about that other big fear? The stock just tanks. No strategy is totally risk-free, right?
Yeah.
How do you handle a stock falling off a cliff when you've got a covered call on?
Yeah, that's the other side of the coin. The premium helps, but it's only a small cushion if the stock really drops hard. You still own the stock, so you're exposed to that underlying price risk. So managing this comes down to a few key things, mostly done before you even sell the call. First, and we keep coming back to this, stock selection is paramount. Seriously.
Stick with quality.
Stick with quality. Blue chips, stable companies, businesses with solid fundamentals. Don't try this on highly speculative stuff you wouldn't want to own through a downturn anyway. That's asking for trouble. Second, you could consider using stop-loss orders on the stock itself. Set a price below which you automatically sell the shares to limit your maximum potential loss. It defines your exit point if things go really wrong. And third, classic advice but always true, diversification. Don't bet the farm on one stock and one covered call. Spread your capital across different quality stocks, maybe different sectors, reduces that concentrated risk.
Those all sound like solid risk management principles: stock selection, stop losses, diversification. But let me push back a bit. For someone starting out, isn't there a huge temptation? You see some super volatile tech stock or meme stock, and the premiums on the calls are massive compared to a boring blue chip. Is the biggest mistake just chasing those huge premiums, even with these safeguards you mentioned? What trips people up most often?
Oh, absolutely. That's a fantastic question because it hits the nail on the head. That temptation, it's real. You see a potential 10% return in a month from premium alone on some risky stock. It's alluring. And yes, the biggest mistake I see is people ignoring that golden rule about owning quality stocks they want to hold. They get seduced by the high premium. They sell a call on a stock they don't truly believe in, maybe one they wouldn't normally touch. Then what happens? The volatile stock does what volatile stocks do. It plunges 30%. That juicy premium they collected, it's completely wiped out, and then some, by the loss on the shares they never really wanted to own in the first place. The premium is income, yes, but it's not free money, and it's definitely not a shield against making a bad investment in the underlying company. Stick to quality. Use covered calls to enhance returns on good investments, not to try and make bad investments look good. That's the key mindset shift.
That makes perfect sense. Don't let the tail wag the dog. Focus on the stock first. Okay, so assuming you've got the basics down, you're sticking to quality stocks. How do you level up? How can you maybe fine-tune this, generate even more income, or optimize the process? Any advanced tactics?
Definitely. Once you're comfortable, there are ways to optimize. First, think about timing your trades with volatility. Remember we talked about premiums. Well, option premiums aren't static. They get more expensive when the market expects bigger price swings. We call this implied volatility, or IV.
So, like before earnings reports.
Right.
Or big Fed meetings.
Exactly. Times when uncertainty is high. Implied volatility tends to spike around known events like earnings or during periods of broad market fear. Selling your covered calls when IV is elevated means you collect a significantly higher premium for taking on basically the same theoretical risk selling a call against shares you own. It's like getting paid more for the same job just because it's a busier time. Second, you can potentially leverage shorter expirations. Instead of selling monthly options, 30, 45 days, some people sell weekly options.
Weeklies? That sounds like more work.
It is. It definitely requires more active management. You're making these decisions every week instead of every month. But the potential benefit comes from that accelerated time decay theta. It decays fastest in the last week or so. So by selling weeklies, you might be able to collect smaller premiums more often, and the annualized return could potentially be higher due to harvesting that rapid decay repeatedly. It's like getting paid weekly versus monthly. The total over the year could be more, but it demands more attention. Not for everyone, perhaps. And third, for those who want the income, but maybe not the active management, consider covered call ETFs.
Like funds that do this automatically.
Precisely. Funds with tickers like JEPI, JEPQ, XYLD, there are several. They essentially hold a portfolio of stocks and systematically sell calls on those holdings or an index. They then distribute that premium income, often monthly, as a high yield to shareholders. It's a hands-off way to get exposure to the strategy. The downsides, you pay a management fee, obviously, and your upside potential is still capped by the fund's methodology. You don't get the stock-specific control. But for passive income seekers, they're quite popular.
Okay, lots of ways to tailor it. This really sounds like it's not just about placing one trade, it's more building a process, a discipline. How does someone go from understanding this intellectually to actually becoming, consistently good at it, profitable?
Absolutely. It's 100% about discipline and continuous improvement, not just one-off trades. So, how to get there? First, start small. Please start small. Don't try to cover your whole portfolio on day one. Pick one stock, one you know well, feel comfortable with. Buy 100 shares or use shares you already own and sell just one call contract against it. Then, crucially, track everything. Write down the premium you received, the date, the strike, the expiration. If you roll it, track the cost or credit. Track your total profit or loss on that one position. Doing this builds real-world experience and confidence without risking significant capital. It makes the concepts real. Second, you have to be reviewing your positions regularly. This isn't set it and forget it.
Right, things change.
Exactly. Market conditions change. Your stock might run up. Earnings might be coming. You need to keep an eye on things. Know those key dates. Be ready to make decisions, like whether to let it expire, close it early, or roll it. Honestly, the best learning comes from actually doing it, making those decisions, and then analyzing why you did what you did and what the outcome was, good or bad. And finally, maybe most importantly, never stop learning. The market evolves, strategies evolve. Keep learning about options. Maybe dig deeper into those Greeks, Delta, Theta, Vega. Understand how they impact pricing and your choices. Keep up with market trends. Keep refining how you pick your underlying stocks. The more you understand the whole picture, the more effectively you can wield this specific tool.
Wow, okay. That's a lot, but it feels like a really complete picture now. So just to recap for everyone listening, you should now have a really solid handle on what a covered call is, why it's so effective, particularly for generating income, lowering your cost basis, giving you some protection. You got the step-by-step blueprint? Own the shares, pick the strike and date, sell the call, understand the outcomes. Plus, how to manage those key risks like FOMO using rolling and downside risk through stock selection and maybe stop losses. And even some more advanced ways to potentially boost returns with volatility, shorter expirations, or ETFs. You're really equipped now, I think, with a plan to take stocks you might just be holding anyway and turn them into a consistent, reliable income source.
Yeah, and maybe connecting it back to that bigger picture. Remember, this isn't just like the single answer to everything. The covered call is one very versatile tool in a much larger investing or trading toolbox. Using it effectively changes how you interact with your portfolio, how you think about returns beyond just price appreciation. So I guess the question to leave you with, the listener, is how will you take this knowledge, this perspective, and integrate it into your own approach? How can you make your assets work smarter, generate that income based on what we've discussed today?
A great question to ponder. Are you ready to put those stocks to work? Maybe start small, like you said. We definitely encourage you, if it fits your goals and risk tolerance, to perhaps try your first covered call. See the power of this strategy firsthand.